Hi, my name is Justin Cass, and I'm a Senior Portfolio Manager on the Income and Growth Strategy for Allianz Global Investors. When we think of what a convertible bond is, it's really two components. It's a fixed income component where you have a coupon, you have a stated maturity, and at maturity you get your principal back. And then there's the equity component, because with a convertible bond, just like it says, you have the right to convert into a fixed number of common shares. So if you put those two components together, that bond-like portion and that equity-like portion, you get a structure that gives you dampened volatility on the downside with an participation on the upside. When we think of the convertible market, strategists really break down the convertible market into three buckets. And what I mean by that is it's really determined by the structure of the convertible bond. There are bond-like or yield-oriented convertible bonds, and just like they sound, they trade more like a fixed income instrument. There's a second component, which are called equity-like convertibles, and again, just like it sounds, it behaves much more like a underlying stock where you capture more of the upside but also more of the downside. And then there's a third bucket called total return convertible bonds. And those are convertible bonds that are right in the middle of both of those, where you get this asymmetric risk return structure where you get this participation on the upside, but more importantly, you get that dampened volatility on the downside, that fixed income component. When it comes to the income and growth, remember, there are three asset classes that portfolio is invested in. 1/3 of the portfolio is high yield bonds, 1/3 of the portfolio is equity, and 1/3 of the portfolio is convertible bonds. I just mentioned the three structures. And again, we really want to focus with income and growth right in the middle on those total return convertible bonds. Why is that? Well, with a high yield market, we already have that fixed income exposure, so we don't want to replicate that with busted or bond-like convertibles. And likewise, 1/3 of the portfolio in income and growth is invested in large cap equities. So we don't necessarily want to be buying equity-like convertibles because we will be replicating that exposure that we already have in the income and growth with equities. So when it comes to the income and growth, we really want to focus right in the middle on that total return convertible bond because of those asymmetric risk return characteristics that I just mentioned.
Allianz Global Investors.